During an accounting period, a business will generate financial information. At period end, you take this information and prepare an income statement. The income statement is a report showing how the business performed during the period. To do this, it shows income, expenses, and profit. At the same time, you prepare a balance sheet. A balance sheet serves a different purpose. To understand this purpose, it helps to see how it's formed. To start a business owner may invest some of their own capital. The business owner would deposit this money into the business's bank account. In addition to this, the business owner may borrow money from a friend or relative. The business owner would deposit this money into the bank as well. You could create a balance sheet right here. A balance sheet shows a business's assets, liabilities, and equity. Assets show what the business owns or what is owed to the business. Liabilities show money owed to others. And equity shows what is owed to the owners or shareholders. A balance sheet is usually prepared at period end, but it can be prepared at any time. No matter when it is prepared, it will provide a snapshot of what the business owns and what it owes at that particular point in time. This way, at any stage, you can find out what the business owns and what is owed to it. You can also keep track of what is owed to others. And you can also keep track of what is owed to the owner. To track these changes, you need to list assets, liabilities, and equity. Assets include cash, things the business owns, and money owed to the business. This is the first thing to be shown on the balance sheet. Cash held at the bank is known as a current asset. Current assets are either cash or things that can be turned into cash within the coming year. The balance sheet also shows liabilities. Liabilities include money owed to others for loans and so on. On the balance sheet, they are shown in the liabilities and equity section. If the loan is a long-term loan, you list it as a non-current liability. Non-current liabilities are expected to be repaid in a year or more. The balance sheet also shows equity. Equity is the difference between assets and liabilities. It shows how much money the business owes to its owners or shareholders. Theoretically, if a business cashed out its assets, then used this money to pay back loans, etc., any money left over would belong to the owner. Equity is shown in the equity area of the balance sheet. You list any capital injections under owner's capital. If updated correctly, the balance sheet should balance. You test this with the formula assets equal liabilities plus equity. First, you add up the asset side of the balance sheet. Then you add up the liabilities and equity side. And if correct, the two sides of the balance sheet will be equal. Typically, a balance sheet will show many things. For example, the business owner may use some of the cash to buy equipment. Once again, you could prepare a balance sheet. In this case, you would list the equipment as a non-current asset. This is because you expect the equipment to last longer than a year. Next, the business may buy goods to sell. If purchased on credit, the goods would come from a supplier. The business may then sell some of these goods. If sold on credit, you would record the sale in the customer account. You can prepare yet another balance sheet at this point. Suppliers are known collectively as accounts payable. Accounts payable are listed under current liabilities. Customers are known as accounts receivable. You list accounts receivable as a current asset. During the period, the business will add more sales and expenses. At period end, you prepare an income statement. The income statement shows net income or profit for the period. This profit is transferred to retained earnings. Retained earnings is also money owed to the owner. It is shown in the equity section of the balance sheet. If calculated profit is correct, assets will equal liabilities plus equity. This means the balance sheet will balance. By now, you should have a rough idea of how the balance sheet works. To do well in exams, though, it will help if you go over this another 10 or 20 times. You can easily do that with this online compendium. It's a fast, pleasant and peaceful way to rote learn. To learn more, go to the link in the description.